So here we are with another episode of Dave's Business Insights, and this episode, which is part of the Momentum series, we'll be talking about the goods and service tax. I'm going to give you a little bit of history, then we'll walk you through the actual mechanics of how it works, and then fill you in on a few special things that you should be aware of. So, first, the history. A lot of people thought or believed that the GST was a new tax, and actually it was a replacement tax. And I should explain that that was in 1991. Yes, 1991. Okay, so originally we had a tax called the federal sales tax, and it was not well known. It was buried. It only affected some businesses, but it was there and we were paying it. Okay, just to sort of give you a precursor, when I'm giving seminars, like to ask a question, which is, what's a word for a business that does not pass on all its expenses, including its taxes, to its customers? Well, the word is bankrupt. If a business, maybe not in the short run, but in the long run, does not pass all their expenses or all their costs on to their customers, and that means their taxes too, then they will go out of business because they have to make money, or at least break even. We used to say that, the line was, businesses don't pay taxes, people do. That was my father's favorite line. And the point being that because those are passed on, it's not the business that pays taxes. Unfortunately, people would always seem to want corporations pay the taxes. Well, that's just burying it. Because when a corporation or a business pays the taxes, they pass it on to their customers. So, in a normal sense, like in the federal sales tax, we ran into duplicate taxes, or taxes on taxes. But let me back up for a minute and go on about the federal sales tax. It wasn't well known, which was unfortunate, but it was there, and it was buried. The problem with things that are buried is it's easy for the government to keep itching them up. And by the time the tax came off and got replaced with the GST, it was up to 13.5%. People didn't know it was there, but it was built into the expenses of everything they bought. And let me give you an example. Printing companies that made letterhead, business cards, all that kind of stuff, they would be required to charge the federal sales tax at 13.5%. So, for example, when I, as an accountant, when I would go to get my printing done, say I'd get $1,000 order. Well, there'd be tax on that, 13.5%. So think about that. So I had to pay that. Now, if you think about it, maybe I should point out that I've been in business for a long time. We didn't go out of business. So what does that tell you? It tells you that my customers or my clients paid the taxes. I didn't. I passed it on. So if you think about it, that printing company probably had an accountant who was also being charged 13.5% or federal sales tax on their printing. So included in their expenses, which they had to cover, was not only their accounting fees and their suppliers, but the 13.5% built into their fees, which meant that you were actually putting 13.5% on top of 13.5%. And if you think about it, especially in the manufacturing case, there could be a tax on the tax on the tax on that. Well, you get my drift. So that was the other problem. Buried, kept being inched up, and a tax on the tax. So in about 91, 92, the conservative government at the time brought in a very unpopular tax, the goods and service tax. Unpopular mainly, I think, because people didn't understand it. But there's a few things they did. First thing is, it was not buried. It's added on at the tills. So people knew what they were charged, and originally it was 7%. It's come down now to 5%. So what's happened? Well, it's very difficult to increase the rate when it's that obvious and when it's blatant and it's out there where people can see it. So it's come down as opposed to the federal sales tax that went up. The other thing is the mechanics, and I'm going to show you that in a minute, because basically it's designed so while businesses pay the tax on their expenses, they get it back. So at the end of the day, it's just 5% at the till level, so there's no tax on the tax, and I'll explain that later. The other thing that they did is they had to come off at the border, which makes it more competitive instead of it being buried in the cost. If you're selling goods and services to a foreign country, there is no no goods and service tax. But when things are imported into the country, there is a goods and service tax, which means it's keeps a level playing field for our companies, and that's a positive. Now, just to point out, when we say it was a replacement tax, and a lot of people don't believe that, well, if you go back to the records of when the federal government was collecting the federal sales tax, you would find that about the time of that change, the government was collecting around $15 billion a year in federal sales tax. And right after they switched to the GST, they were still collecting around $15 billion a year federal sales tax. So essentially they replaced one revenue with another, but with a better system than the one they had. So that's a basic history of how it came about and what the positives of the tax are. One could argue there's no such thing as positives about taxes, but it is probably a better tax than most. So that's that part. Now, I want to take a few minutes and explain the mechanics. You'll be surprised how simple it is in its normal form. The basic mechanics of how we collect it and how we pay it. It's not really that complex, and I'm going to walk you through it. So let's just turn to some charts here, and I'll walk you through it.
Here is the basic mechanics. Okay. So now you've started a business, you're registered for GST, and you made your first sale, say for $1,000 plus 5% GST. So what do? Well, you credit revenue of $1,000, that you probably knew, but what about the GST, the 5%, or $50? So to deal with that $50 GST collected, you would have a liability account on your books, probably called GST collected or something like that. And you would credit the GST collected account $50. If that was your only transaction for the reporting period, at the end of the reporting period, you would submit a form plus $50 to the government. But as you know, you probably have expenses. So let's look at those. So let's say you have a bill from your accountant for $500, which would include, or be on top of that, there'd be $25 GST. So again, you put it in the $500 to the appropriate expense account. But what do you do with the $25 that you paid your accountant, who effectively is acting as a tax collector? Okay, so now to deal with that $25, you would have an asset account, because actually that's money you've paid, or you might call it a negative liability, and that would probably be called GST paid or something like that. And you would put the $25 into that account. Transactions, or your only transactions for the period, well, you would have an account called GST collected with $50 in it, and a GST paid with $25 in it. So when you filed your return, you would show what you collected, because nice person you were acting as a free tax collector for the government. And you would put the $50 that you collected, $25 that you paid the other tax collector, that being your accountant. So you'd have the $50 paid less the $25, or $50 collected less the $25 paid, leaving $25, and that's what you would submit to the government. Now, if the number's been reversed and you'd had more expenses than you had revenues, then you would have had a refund. So this is one of the good things. This is the basic mechanics how it works, and it's pretty straightforward. But one of the good things here is that because you get back what you've already paid through your expenses, you effectively do not pay the GST if you're a registered business. The good part of that is that it means that there's no tax on a tax on a tax, etc., etc., etc. It's straight 5%. At the end of the day, there's a 5% tax to the consumer, to the final consumer, and that's it. So that is one of the better things. So that is the basic mechanics of how the GST works.
Okay, so that's the basic mechanics of how the GST works. Now there's some special things here that we should talk about. The first one is who needs to register or whether you should. And we won't go into great detail, but I will say most businesses will fall into that category. Talk to your accountant. But if your business is doing less than $30,000 a year in sales, you don't have to register, but you might want to. There's a couple of things to keep in mind. If you're a startup business and you're doing less than that, then it's true. You probably don't have to register. But as your business grows, once you hit $30,000 in a fiscal year, you have to register. So I would say make sure you're registered before you need to. But some of the things you should keep in mind. Just because you fall under the threshold and don't have to, doesn't mean you don't. I mean, what it means is you don't have to. Doesn't mean you can't. So you might want to consider registering as soon as you can and maybe right away. A couple of things to keep in mind. One is the input tax credits or the GST paid that I just talked about. Well, you won't get that back if you're not registered. Another thing is that people expect to pay it anyway. They're not surprised when they see it. So you might want to look at that and say, well, and it's going to be easier to start charging it at the beginning than to add it on later when people have got used to you not paying it. Also, if you are thinking, well, you'll hold off, maybe you should ask who your customers are. When I'm buying something and I ask a price for business, for a business purpose, people will often say so much plus GST. Well, my reaction is I don't care about the GST because I don't pay it, because in fact I get it back. So if your customers are businesses, register and collect it, because the businesses that your clients or your customers are going to expect it anyway, and they're going to get it back, so it makes sense to do that. If they're not, if they're the final consumer, then you might say, well, you know, I could probably charge a couple % more, which will cover my cost of GST, and that's a better deal for my customers, and I'm competitive, and that may be the case, and you might consider that. Although keep in mind that if your business grows, there will be a day when you have to charge GST. So then you'll have to make a change. So you might be better off just to start with that. And here's another thing to keep in mind. Do you want your customers to know that you're making less than $30,000 a year in sales? Because if you're selling a product that's GST taxable and you're not selling GST or not charging GST, it means one of two things. Either you are making less than $30,000 a year, or you're a tax evader. So keep that in mind and make a decision when you want to register, if you are in the group, the threshold group. All right, the next thing I want to talk about is there are three categories in the goods and service tax. The first one is items that are fully taxable, and most things fall into that category. So, they're pretty straightforward. And with those, you charge 5%, and it goes through the same mechanics as I explained earlier. We have another group called the zero rated group. This is mainly food. The rate was going to be lower because it was going to cover virtually everything, including food. Well, the politics of the day was people said, oh my God, you can't tax food, as if we aren't taxing it anyway. It was just, this is more blatant. So the government said, okay, instead of charging, say 3%, 4%, whatever, we'll charge 7%. Because they were going to collect $15 billion a year either way. That was the goal. The question was whether more comes out of one pocket or comes out of two. You don't get the analogy. So they took out food and a couple other things. Now that, of course, created some more complexities. Because now you have to define food. The favorite example is the donut example. And that's where, and I'm pretty sure this hasn't changed, but at any rate, that's where if you are selling donuts or buying donuts, if you buy one, it's considered a treat. 1 or 2, it's classed as a treat. There's GST. But if you buy 6, it's classed as a food, and therefore no GST. So basically, then this sounds it's kind of funny, but the fact is they had to find where do you draw those lines. So that's what they did. And the zero rated are the items. The food in those items, they're taxable at zero rate, at a rate of 0, which means 0. But what's important for those groups is that they get the input tax credit or their GST paid back from their expenses, so that there really is no GST and nothing buried. My father-in-law is a farmer, and when this first came out, he called Marion and said, should I be registering for this? And she said yes, because you won't be charging it, but when you buy your supplies and your fencing equipment and all that, there's going to be GST and you want to get it back. So, which case he did. And the final group is probably the worst group to be in. That's the exempt group. It's mainly medical type expenses. Your dentist and doctors, things like that. The worst group to be in, they're called exempt because you don't get to charge it, but you also don't get the GST that you paid back. You just have to cover it, which means it's built into your expenses or built into your cost, which means your selling prices have to include it. So that's the final group. And I should point out, as I have in all the other videos, this is all as of 2020, Alberta and in Canada. But I'm telling you, in the future, things can change. Now, there are also, on another note, some quicker methods. There's some thresholds. So some small businesses will be able to use those. They came out because everybody thought that GST was going to be overly complex. So the government gave some options for smaller businesses, or for some smaller businesses. I'm not going to go into them here. And it's a moving target anyway. You talk to your accountant. To be honest, what happens with these, it's not that people do them because they're simpler, but the accountant looks at the business and sometimes says, you know what, you'll be paying less in if you use the quick method. So you do. You have to do elections ahead to use those methods. Or they may say, no, don't use it because you're ahead. So it becomes an economic decision, not a decision about what's simpler or anything like that. Okay, now another area I want to talk about is the harmonized sales tax, the HST. There are 5 provinces, basically Ontario plus the Atlantic provinces, that have elected to harmonize their sales tax with the GST, which actually was probably a smart thing to do. It means that in those provinces you don't get hit with a provincial sales tax and a goods and service tax. You get hit with one harmonized tax. It really makes life simpler. Of course, in Alberta, we aren't harmonized because there is no sales tax, but in the other provinces, there's 2. And, especially for small business owners and storekeepers, it makes life a little more complicated. The rates for those, as of right now, are in Ontario is 13%, and the Atlantic provinces, Nova Scotia, New Brunswick, Newfoundland and Labrador, and Prince Edward Island are 15%. Now, this is important, even if you're not in those provinces. If you're in those provinces, you charge the rates, obviously. But if you're in other provinces, then you have to consider the rules of supply, because you will need to charge the rate that applies to where you're selling. And just to give you an idea, I printed, here it is, the GST, HST rates and place of supply rules. Actually, I didn't print it all. There's a bunch of stuff on things like railroads in here too. But this is like, I printed here, just take a look. 47 pages. If I printed the whole works, probably be 50 some. All about where did a transaction take place, because you got to know for this how to charge it. This is one of the places where it gets a little more complicated. Now, I would refer you to that and say make sure your accountant's aware of it so they know the rules. But I'm going to give you some of the basic rules of supply, and I want to point out this again is, as of now, this document I just showed you was last updated in late 2019, and it may change again in the future. So what I'm going to give you is a very quick, easy summary, but I should point out, stress the word easy because it's taxes. It's not necessarily easy. They'll give you an idea and a guideline, but they'll hopefully cause you to stop and think when you need to do something different and to check with your accountant. And I'm sure there's a lot of accountants, maybe even most, are not aware of this document, so you might want to make sure that they are. Okay, so for goods, your basic goods that you're selling, they're sometimes referred to taxable supplies, but or other items. But anyway, your basic goods, like if it's a physical good, then it's a little more, it's fairly straightforward. Not perfect, but overall pretty straightforward. The question really is, where did you deliver it to? If you delivered it to the other party, the purchaser in your home province, you're good. It's the rate for where you are. If you delivered it to another province, then it's the rate of where it's delivered to, whether it's through a shipper or any other method. It's how did you deliver it? Now, if the person or a customer comes to you and purchase it and they leave with it, then it's the rate at the province where you made the sale. But if you are delivering it to another place, then it's where you delivered it to. That's relatively straightforward. There's a couple of little quirks in there, but basically that's pretty much what you're dealing with. Certainly, if you're doing business with customers who are in your province, then you charge the rate for your province, you're pretty much good to go. But just be careful. Now for services, it's a lot more complicated. And one of the things that really complicates is the internet. And think about it, somebody's writing web pages or something. I mean, you could be selling to, Timbuktu and never know even where the person you're working for, your customer, is. So that's played a big role here. So I want to read you what I've written in my notes for the Momentum seminars that I give. And it gives you an idea. It's tricky, so you really need to go into the details. Like I said, that most of this 47 pages is about services and where they took place. Okay. So here's what I'm going to say. Okay, it can be tricky. There are many specific rules. Okay, and of course, always going to be interpretations. Okay. So in a very, very general way, okay, if the main address of the recipient of the service is known, or you are doing work for a specific office, then you should use the rate of that province as the rate of the province of the specific office or of the customer. If the recipient's address is not known, use the rate for the province where the majority of the work was done. Okay. So in other words, if you don't know where it went, then where was the work done? That's the rate that you use. Okay. If two or more are done equally, then you use the highest rate, and I believe it also says if there's done in a couple places, but most of it's in one, then you might use the one. But if they're equal, We used to say prorate, but now this document is saying that you use the highest rate. So in other words, if half the work was done in Alberta and half the work was done in New Brunswick, then you would charge 15%. Again, that's if you don't know where the customer is. So that is sort of summarizes it in a way that hopefully will make it understandable. But again, please, 47 pages. So when you're dealing with out of province, you want to take a careful look at that. So that's the basic things to do with the goods and service tax. I hope you find that helpful. Of course, I trust you have an accountant and they'll help you with it. And remember, the rules change. We are talking right now. This is July of 2020, and rules change and interpretations change because, as you know, tax is gray, but also politicians change the rules. So you'll want to know what's going on now. You want to get advice in your clients, but you also want your accountant to be on top of what's going on and what changes, because it changes a lot. So that's my presentation on the goods and service tax. I hope you found this helpful and informative and useful. If you have, please like and share this video. And again, don't forget to subscribe to this channel. So thanks for watching this episode of Dave's Business Insights.